Gold continued to trade in a sideways fashion around the 1650 level during the past week as investors appear hesitant at placing any big bets ahead of the highly anticipated Fed's November meeting. During today's session, we have seen the pressure gain some ground as US bond yields were on the retreat, with the 10-year falling below the 4% mark, remaining, however, relatively elevated near its 14-year highs. In this report, we aim to shed light on the catalyst driving the precious metals price, assess its future outlook, and conclude with a technical analysis. Without a doubt, the next big test for gold prices is the upcoming Fed's interest rate decision tomorrow, the 2nd of November. The market consensus anticipates that the central bank will proceed with a jumbo 75 basis point rate hike for the 4th consecutive meeting, pushing the Fed funds target rate to 4%, a level once seen before during the global financial crisis of 2008. Currently, the FFF implies a 98% probability for the above scenario to materialize, and should that be the case, we may see the dollar strengthen and the pressures facing headwinds due to their inherent negative correlation. However, we must note that the 75 basis points expectation may have been already priced in by the market, and the aforementioned reactions could be toned down. Drawing from this, the market appears to be more concerned with the December meeting and the projected interest rate hike prospects as we edge closer to the end of the year. That is of particular importance since the terminal rate for the year end of 2022 was set at 4.5%, implying that the Fed's last hike for the year is anticipated to be 50 basis points. However, during the month of October, we had some Fed speakers proclaiming that the Fed may need to push past the 4.5% initially discussed. Minneapolis Fed President Kashkari was one of the Fed's envoys that cited a 4.75% terminal rate entering the new year as inflationary pressures remain stubbornly elevated and fail to abate, raising concerns that they may become deeply entrenched within the US economy. On the other hand, St. Louis Fed President Bullard stated that the bank may have to end the front-loading of its hikes, implying a shift in the coming year with more rate hikes still possible yet. The correction mode and of smaller size. It should be noted that economists seem to consider some Fed policymakers viewing inflation currently as a lesser problem than initially thought and are suggesting that the Fed may proceed with a lower 50 basis point rate hike in the December meeting, a view that seems to be shared also by the market partially, as Fed fund futures seem to provide a probability of 57% in favor of 50 BPS and 43% for a 75 basis point rate hike. We have to note, nonetheless, that the Fed will have to grapple with the new incoming data in regards to employment, inflation, growth, and consumption reading leading to the December meeting, which the results can alter the projection significantly. Even though market worries for inflationary pressures remain present among market participants and may still keep the USD at relatively high levels, we hold the view that the Fed may have to start slowing down its rate hiking path in order to reach a full stop in the midst of next year and reassess the overall effect that its monetary policy tightening may have had on the US economy. Should the market's expectation for the Fed to ease its monetary policy tightening pace, we may see the USD experiencing some safe haven outflows, while gold's price, which is considered to have a negative correlation within the greenback, may benefit. Lastly, Fed Chair Powell's scheduled press conference after the decision will be another defining factor for the future outlook of gold, as the head of the central bank could provide valuable clues for the monetary policy stance of the bank. Finally, even though gold is considered to be a safe bet during times of economic uncertainty, interest rate hikes increase the opportunity cost of holding the bullion. In our assessment, gold will continue to be driven by sentiment in the dollar in the short term, and odds for gold raising to previous high levels diminish given the current state of things. Thank you for watching.